Jerry, thank you for that introduction. It's my pleasure to present the forecast for the US economy. Our forecast is pessimistic for the next few months for a gloomy COVID winter, and then optimistic starting in the springtime for an exuberant vaccine spring, followed by continued rapid growth through 2023. So a summary of our forecast is that as COVID cases rise, as we have stay-at-home orders, as we have a looming expiration of emergency unemployment benefits, we expect weak growth of less than 2% annualized this quarter and next quarter, and potentially we might have another negative quarter of economic growth. And then with mass vaccinations, we expect robust growth of 6% annualized in the second quarter, and then consistent growth thereafter above 3% through 2023. But the next few months will be very hard. We expect weak labor markets, we expect continued food insecurity, and we expect continued housing insecurity as the foreclosure moratoriums, as the foreclosure and eviction moratoria expire. Starting in the spring, we expect mass vaccinations will release pent-up demand and lead to a surge in consumer spending. And we expect that housing services will remain strong through at least 2023, fueled by low mortgage rates and by demographic shifts. There are quite a few assumptions going into the forecast. First is that COVID cases will remain high for these next few months, but stay-at-home orders will not be as widespread and stringent as they were in March and May. We expect an additional $1 trillion in fiscal relief in January. Current congressional negotiations are at around $908 billion. And we expect additional state and local government support of $200 billion for mass vaccinations. And to put that into perspective, we had $150 billion this past year for all the testing that state and local governments did. And then we expect limited vaccine rollout to healthcare workers, frontline workers, and vulnerable populations starting as soon as next week. And then mass vaccinations for the general public starting in March and April. So with these assumptions, what we have is this slow growth of 1.2% now in this fourth quarter. And that's coming off very rapid growth of this 33.1% annualized in one quarter right before in the third quarter. We expect growth to slow down substantially. So this fourth quarter, 1.2%, the first quarter of next year at 1.8%, and then at least 6% growth in the second quarter and consistent growth above 3% annualized all the way out through 2023. Where this leaves us is still below the 2019 peak right now in Q4. We expect to be 3.3% below where we were at the end of 2019. At the beginning of the first quarter, we expect to be 2.8% below where we were in 2019. We only expect to reach 2019 levels at the end of 2021 of real GDP, but that will still leave us 4.8% below where we should have been, below the trend if this pandemic shock had not happened. And so for this next 3 years, we will grow above the 2.3% trend rate that we had prior to the pandemic, but it will take us a while to catch up. Even by the end of 2023, we'll still be below where we should have been had the pandemic not occurred. Now, why is the recovering stalling? This all has to do with surging COVID cases. So we've seen in the news the rise in the number of reported cases, the rise in the number of deaths. We've seen stay-at-home orders affecting 33 million Californians. And we had Dr. Birch talking about how this will be the worst event that this country will face, this winter COVID surge. All that is causing consumer spending to come down and growth to come down right now during the fourth quarter and into the first quarter. The second point is that the employment recovery has been slowing. So the US is currently at the same level of the jobs deficit that it had at the very worst point during every previous post-war recession, including the Great Recession. So if you look at the red line, that's showing how much employment dropped, how much we lost in jobs for every month since the last employment peak, which in this case would have been in January 2020. So you see employment fall almost by 15%, and then increase very rapidly the few months thereafter, but that rate of increase has been slowing. And now we're gaining very few jobs. We gained 245,000 jobs during this past month. And that's, in normal times, that would be a very good rate, but given the deficit that we have, that's not enough to get us out of the hole rapidly enough. And so the dashed line is showing you the trend of how long it will take until we make up for the number of jobs that we lost in this pandemic. And currently our projections is that it will take us 41 months. So basically the second worst of every recession since World War II, aside from the Great Recession. The unemployment rate currently stands at 6.7%. That actually doesn't capture how bad the situation is, because a lot of workers have left the labor market, and that artificially makes the unemployment rate seem too low. So we have 10.7 million unemployed. That gives us this 6.7% unemployment rate. If you then take into account all the workers who are on temporary layoff and who, if they were recalled, would come back into the labor market, and then all the people who are not in the labor force that would come back into the labor market because of these new opportunities, that would increase the unemployment rate to 7.2%. If you, on top of that, take into account the 4.7 million workers who left the labor force or who are not at work for other reasons, when they respond to the survey, they mention not at work for other reasons, that would take the unemployment rate realistically up to 8.5%. And so that's where we are now, much better than we were in April, but still a very high rate. This 8.5 is a blended average across the population. But the numbers are much worse for Blacks and Hispanics, above 10% for Black men, compared to the 6.7% official unemployment rate. What we also want to talk about is how employment has varied by sector. So I want to spend a little bit of time on this chart that came from Ernie Tedeschi from Evercore ISI. And what this chart shows, let's focus on leisure and hospitality. If you take the height of the blue bars, that's going to give you the total amount of employment lost in leisure and hospitality through April, between February 2020 and April 2020. And so during that time period, leisure and hospitality lost 50% of employment. If you then look only at the dark blue portion of that bar, that's where we are today, or as of November 2020, we gained 30 percentage points back. So now we're down 20% of employment in that sector. And if you look at the yellow dot, that's where we were at the height of the Great Recession, or following the shock in 2007 from the Great Recession. So what you can see is that leisure and hospitality had this tremendous shock. It gained back more than half of the jobs that it lost, but compared to the Great Recession, it's still far above where we were at the worst point then. If you look at the bar above, overall non-farm employment, the blue bar, the dark blue bar, and the yellow dot are exactly the same point, which means that we are at as much of an employment loss as we were at the worst point of the Great Recession. The last thing to note as you look up and down this chart is that back in April, you had these losses across sectors that looked roughly equally as bad. And that was one of the reasons that that Congress, that the country was so much behind the CARES Act that would provide broad benefits across the population, is because at that time, it looked like all sectors were as badly affected, as badly impacted by the shock. As time has gone on, if you look at just the dark blue bars, we can see which sectors are worse off. And we can see that in some sectors, including construction, including retail trade, including transportation and warehousing, including financial activities, the shock turned out not to be that bad, right? Still bad, still employment being down, but not as bad as originally thought in the beginning of this crisis. And so that changes the conversation about what kind of additional fiscal relief do we need? Do we need fiscal relief targeted at those who are unemployed? Do we need a broad fiscal stimulus? And on that topic, we have this presentation by Professor Ed Leamer on our website that discusses the trade-offs between a broad package or a more targeted package. We've seen with high frequency data that consumer spending is beginning to stall. And so you see this decline in Black Friday shopping. This doesn't account for Cyber Monday, but even once you take in the Cyber Monday spending, we're still below spending levels that we had this time last year. You also see this very notably in terms of revenues that small businesses are earning. So especially by mid-October, as COVID cases were rising, small business revenue that involves more in-person shopping, you see this coming down by about 5 percentage points from mid-October levels. So the situation is becoming more dire for small businesses. Now that said, this is the pessimistic side. There's a lot of optimism for what will happen once we get mass vaccinations. So for those that have not lost employment and not lost income during this crisis, their financial situations are actually much better off now than they were before the pandemic. We've seen on the yellow line, this is credit card and revolving account balances. You've seen that go down by 100 billion during this pandemic. People have paid off their credit cards and paid off their balances more during the pandemic. The red line shows you accumulated savings. So personal savings are now up 1.6 trillion. The spike that you see in personal savings is because of the stimulus and aid distributed earlier this year. That led to a lot of savings accumulation. People have since drawn that down, but still total savings is about 1.6 trillion above where it was before the pandemic. So that's a lot of extra cash that people are holding that is pent up and that we expect will be spent as people are able to go out and participate in in-person activities. And then we have both equity markets and home prices at record highs. And while this isn't realized wealth, you don't realize this until you sell your equities and until you sell your home, this gives the perception of wealth. And so going into springtime, this should lead into consumer optimism that consumers are well off. That should lead to a big surge in spending that then trickles throughout the economy. When we look at our forecast for consumer spending, what we're expecting is an increase in service spending as the economy opens up, a decline in goods spending. So if you focus on the services line, you saw that services spending went down with the pandemic. It bounced back about halfway. And then what we expect is essentially a 0.3% growth right now into the fourth quarter. And that's basically remaining flat. We expect very little change in services. Throughout the next year, throughout 2021, we expect this 6.1% growth in services as people are able to go out and spend and participate in in-person activities and go to restaurants and go to bars and go to entertainment. On the goods line, you'll see that we increased goods spending substantially between the second and third quarters of 2020. We expect basically things to remain flat, a very modest decline of 0.6% going into the fourth quarter. Even as people are consuming more goods than services, we also expect some saturation, that a lot of the spending on goods that people would have been doing, they've already done in terms of buying more electronics for their kids, given the necessity of homeschooling, in terms of buying more household furniture for their home offices. We expect that a lot of these good purchases have already occurred, and so we expect that to decline going into the fourth quarter, and then basically remain flat for the remainder of next year, so that goods purchases, goods consumptions returns to trend slowly over the course of the next 3 years. Focusing on specific sectors within services, we expect the service recovery to be led by healthcare, by restaurants, by recreation, by travel and accommodation. Restaurants, recreation, travel, and accommodation, perhaps that's fairly obvious that once we can go out and spend, people will go to restaurants more, people will go to entertainment more, people will travel more. The healthcare one is related to elective healthcare. So this is people forgoing healthcare that is non-necessities at this time. and then going to more dentist appointments, going to more preventive care, starting in the second quarter once the economy opens back up in full. Healthcare also includes social services and childcare, and so we expect that to ramp up considerably once the economy reopens. The flip side of this is spending on consumer goods. So we expect recreational goods, household goods, electronics, other household durables for there to be saturation. And so a modest decline on consumption spending on these items that will get this back to the normal trend by the end of 2023. Housing markets we expect will remain strong and will help propel the recovery. So the blue line, that's home builder confidence index, that's at a record. The orange line is housing starts, how much new housing is being built. We are at levels that we haven't seen since 2007. We expect this to remain elevated above 1.4 million units per year through the end of 2023. And that, of course, being driven by low mortgage rates, but also demographic shifts as millennials age into starting families and into home purchasing. So on that topic, here we have the demographic distribution in the US. And what you see, what this arrow is pointing to, is this increase in the number of people in ages 27 through 40. As these people are entering their prime earning and home buying years, they're going to drive consumption spending and home purchases. We expect inflation to remain muted. There's a lot of excess capacity right now. And so even as consumer spending on services surge, we don't expect much of an increase in inflation beyond the 2% target of the Federal Reserve. And then lastly, we expect unemployment declines to be tempered by rising labor force participation. So yes, there will be a lot of demand in the economy, especially starting in the second quarter, but there are a lot of people who are outside of the labor force who will be moving into the labor force, and that's going to mitigate how quickly unemployment can decline. So while the economic situation is improving, we're still going to have a lot of workers out of work through 2023 until we return to around a 4% unemployment rate by the end of 2023. So in summary, we expect rapid growth, but with a few more months of significant hardship. The vaccine will release pent-up demand. The next few years will feature strong growth as the economy accelerates and then returns to previous trends. This we expect to be driven by consumer spending and strong housing markets. The risk to the forecast is whether there will be additional fiscal relief to bridge the next few months until vaccines become available. If we don't get additional fiscal relief, our forecasts of growth less than 2% during these next 2 quarters, that might be too optimistic. In the longer term, we expect favorable demographics to continue fueling economic growth for the next decade. But as we'll discuss during the remainder of this conference, climate change poses a significant risk to future growth during this next decade.